Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. In the case for a chat today, well, after the Fed's decision that has come out, you can't talk about anything else but the possibility of rate cuts. And would rate cuts in the second half of the year, consecutive as they might be, make emerging markets an attractive destination or more attractive? That's the first point. We talk about whether private capex recovery is underway or no. And when it becomes underway, would it help select facets of the market? Our guest today has arguably been constructive on BFSI. We talked to him about whether there is more in store for BFSI, or rather whether 2024 will be a year wherein BFSI stocks can finally show or prove their mettle. Our guest today is Dhiraj Agarwal, MD of Ambit Investment Managers. Dhiraj, great having you. Thanks for taking the time out.
Hi, Niraj. Thanks.
Dhiraj, can't not talk about what the Fed said, leaving the case for 3 rate cuts unchanged, which was a bit of a surprise to many. And Jerome Powell also talking about slowing down QT at some point of time in the year. What did you make of the commentary, and what would it mean for emerging markets like India?
It's clearly a dovish pivot in this particular commentary as compared to the last few commentaries coming in by Fed, which has been slightly on the hawkish side, I would say. And I would add slightly, because it's not that the Fed has ever indicated that they will not be going into a rate cut cycle, but they've always maintained that they wanted to see inflation sustain at their target rate of roughly 2% before they're actually going for any rate cuts. And this was a little bit more specific guidance that markets can expect 2 to 3 rate cuts, maybe 3 rate cuts in the second half of this year. So certainly it is a dovish turn, and the impact of that we are seeing on the emerging markets all across this morning, including India. This certainly removes one uncertainty, because 2023 we started with the markets expecting rate cuts in second half of 23. It did not happen. 24 we started with expectations of rate cuts as early as March. It got pushed out to June or July. So this is the first time there's a little bit more certainty. So more than the cut itself, I would say it's a certainty of this event happening rather than a risk of it getting postponed yet again, is what the market is happy about.
Got it. Dhiraj, sometime at the end of last year, risk assets started factoring in that there will be these rate cuts. Then there's a doubt that crept in the first couple of months, also showing in the way the yields have behaved recently. I would only want to understand from you, what do you think the stance of a foreign portfolio investor might be? Because hitherto, we've missed FPI flows into India in a meaningful way in the last 6 months odd, give or take a few sporadic instances. Does the US economy performance, does Japan's policy normalization, and does a potential troika of rate cuts from the Fed alter the FPI stance in any fashion into India?
I don't think so, honestly. So FPIs have been struggling with one basic variable in India, which is the macro looks outstanding and the micro is a little mixed. And second, within the whole microsphere, wherever there is high confidence in terms of earnings delivery, the valuations are a little bit of a concern. So I don't think any of these factors go away. So some of these macro variables are very good to move the markets on a short-term, near-term basis. But once you zoom out and then once again you start focusing on what the earnings delivery of the economy is. And on that front, I've maintained that for this year, the markets will be non-linear. And when I say markets will be non-linear, I basically try to imply that markets will be very volatile through 2024. And the primary reason for that is earnings performance of the market. So last 3 quarters, while Nifty earnings have grown at 23-24%, sales growth is only 5%. And bulk of the earnings expansion is coming through margins. The positive impact of the falling WPI will start to fade away very, very soon. And if sales growth doesn't pick up, we have a slightly choppy earnings season into the coming quarters, and hence the choppy markets on our cards.
So is that the base case, that the optimistic numbers of FY25 on the EPS growth front might actually come under question?
Yes, that's my base view. that the optimistic earnings estimates of FY25 will keep seeing cuts. 5% sales growth is far too weak. And remember, this 5% sales growth of the previous 9 months is despite a 9 odd percent nominal GDP growth. So Nifty sales growth is lagging the nominal GDP growth by a good 400 basis points, which is not a good sign.
Why would that be happening, Dhiraj? Just trying to understand this.
Two possible explanations for that. One is if you listen to most of the consumer companies' commentary in the previous result season, almost everybody said that the smaller regional players have bounced back very, very strongly and taken market share away. And I'm extrapolating that a possible reason what has given fillip to the smaller regional players bouncing back is in the last 6 to 8 quarters of cost benefit for listed companies, instead of pricing that passing that benefit onto the consumers, the companies chose to increase margins. So just to give you an example of Unilever, just for an illustration point, because Unilever is the largest consumer company in the country. Over 4 quarters, the gross margins have gone up by 900 plus basis points. Now, at those kind of margins, regional companies are viable once again. So the smaller regional companies went through this whole pain of winding down a little bit because of formalization and GST, but now they've got their act together in terms of getting more formal. And with this additional booster margins, they're profitable again. So some amount of market share is being lost to unlisted players. That's possible reason number one. The possible reason number two is the K-shaped of our economy. So luxury is doing fantastic. Mid and bottom is probably still struggling to some extent, which basically means that a large section of a listed space, which is exposed to mid and lower segment, are still struggling.
Fair point. Could there a case be made for mean reversion for this as well? I mean, you're right. I mean, base consumption has struggled, staples has struggled. So I'm kind of making a segue into consumption, if you will, Dhiraj. But do you think a mean reversion could be, a case could be made or predicted, or would you rather wait for evidence to show up on the screen?
I mean, honestly, I would rather wait for some evidence to show up on the screen because, I mean, it's easy to take a mean reversion call if the valuations have reached a level where they're clearly in the cheap territory. And then you can say at these valuations, even if I have to wait for a few quarters for a mean reversion trend to restart, it's fine. But that's not the case yet. So I would rather wait for some signals.
Point well taken. Thanks for that insight. The other one, Dhiraj, that I want to talk to you about, and there's this Morgan Stanley note today, Asia EM note, which speaks about they're saying that it's India's decade and India and Japan still remain the preferred markets, etc. And of course, their considerations are very different than what a local managers would be, but I'm still trying to understand. The argument is that there is it's a good domestic alpha opportunity because private capex finally seems to have entered a clear upcycle. We've been missing private capex for a long time now. I would love to understand what are your thoughts, I mean, your and Ambit's thoughts when it comes to private capex. Has it taken off to your mind, or is the proof still missing?
No, it's picking up. It's picking up. So on this whole capex front, I would like to put two things on the table. One is it has been picking up. This has been a capex-driven market. But at the same time, one should take cognizance of the fact that the capex growth or the private capex growth is not as strong as what the headlines make it out to be. So they're offsetting impact. So even on the government capex in the last few years, while the government budgeted capex has gone up very, very strongly, the PSU capex has been a little bit under pressure. So if you consider public capex as PSU capex and government capex combined, the growth is more like single digits, but it sounds a lot more because the on budget government capex growth has been almost 23-24% in the last 3 years, 17% budgeted for FY25. So capex will pick up undoubtedly. The capacity utilization ratio for India as a country as a whole is reaching 77-78%. At that point of time, you have no choice to start reinvesting. So yeah, we are optimistic on private capex, but just temper it down in terms of what extent and size and strength of the whole capex.
Got it. And okay. And Dhiraj, just before we slip into that break, so the headline number not that strong, but a bit of a pickup. Maybe the pickup comes in. I was looking at a note by Pranjul Bhandari of HSBC, who said that in select cases, and I wonder if your view is the same or similar, in that some of the capex that is happening in sectors wherein the initial spurt is not as high as maybe what will come about in the next 2 or 3 years. So both FDI will come into some of these sectors, and the resultant up move in capex over the next 24 months on the private side would be thick and fast. Could that be possible? And could that have a multiplier effect? Sorry, that's my main question.
Yeah, see, the capex will certainly pick up. So both in terms of capacity utilization number, which I gave, as well as some of the new sectors that we're building, like semiconductors, EV, etc., where new money is coming into the ground. So capex will certainly pick up. We will continue to be sort of a capex-driven economy for the next few years. And I would just link it back to the consumption discussion that we had a while ago. So, mathematically, and we have seen that in the 2003 to 8 cycle as well, when the capex growth is picking up, the consumption growth tends to take a backseat. Anecdotally, why does it happen? Because a lot of consumption and capex in the Indian context, the way our national accounts is defined, the household savings and household consumption, a lot of it is actually goes into businesses as well. So when there is a tendency, or when there is a positive bias towards the economy about reinvesting more in your own business, many people just tend to postpone consumption, whichever areas it can be postponed, to be able to free more capital for investment. So there's always a little bit of a trade-off between I and C. So I would say that within the GDP component, I will continue to grow at double digits, which is what it has been doing in the past, which will put a little bit of pressure on C for the next few years as well. That's high likelihood.
Okay. Sorry, just a follow-up. I'm tempted to ask this to you. So would you believe the bottom end of the C will suffer, or the premiumization, which has held out for the last 3 years post-COVID, will come into question?
I think premiumization is probably shielded.
Okay, shielded. Okay, fine. Okay.
At that segment, even the high ticket spends is not that large percentage of expenditure of
Got it.
the super rich, right? So that just continues to go on.
Got it. Interesting point. Well, we told you first on February 26th that work hard. The company was looking to raise funds via QIP. The announcement has now been made. My colleague Smriti, who broke the story then, has more details. Smriti, good morning.
Good morning, Niraj. Yes, we broke the story here first. Now it's public that the company is looking to raise 350 crore rupees. Now that's the base offer with a green shoe option of 220 crore rupees. The issue price is set at 517 rupees, which is about 5% discount to yesterday's closing. Now the equity dilution post this issue is around 7.1%. And now remember, in August of 2023, the shareholders of the company had approved a proposal to raise 1,600 crores via public or private placement, and now out of that 1,600 crores, they're looking to raise 350 as a base offer.
Okay, Smriti, thanks for thanks for bringing us this detail, and of course, I'm sure we'll keep us updated with what happens with the QIP response as well, supposedly strong. And that brings me to healthcare as a pocket as well. I mean, Wockhardt is a specific case in point and important to highlight today. But Dhiraj, healthcare is, in some sense, chalk and cheese, isn't it? The US generic makers have had a good 2023 after a long lull, if you will. But as a overall pocket, it's kind of has its ebb and flows with more downsides than upsides. I mean, is there a trend that could be predicted for healthcare per se?
Yes, I think there is. I think US generics is on an uptrend, and these uptrends don't fizzle out in a short span like 1 year. So the previous US generics uptrend we saw topped out in 2014 after a good 11, 12, 13 years of a very, very strong uptrend. It's been in a downtrend since 2014, 15 approximately, with price erosion, double-digit price erosion, sometimes even high teens. Continuously right up till 2022, 21, 22, which is when it started to bottom out. So a 8-9 years of down cycle does various things. It forces weak players out of the market. It forces consolidation. It forces a little bit of a supply deficit because people underinvest. And a time has come where a number of generic drugs are actually going into a little bit of a supply deficit scenario as well. With few specific drugs, sometimes there has been supply shortages as well. So I would say this whole US generics uptick, which has happened, is not an uptick, it's a reversal of trend. At the very minimum, it should last 5-7 years. So I've been very constructive on pharma from a medium long-term basis, at least for now.
And is it contained to US generics only, or do you believe other facets of healthcare? I mean, people talk about CDMO being this multi-year opportunity where people are not seeing the, people might miss the forest for the trees if they look at only the near-term performance, or for that matter, hospitals and diagnostics as well. Anything on those lines?
So positive on that too. So CDMO is, in some senses, no different as compared to any offshoring sort of a strategy, any offshoring kind of a business. And there are multiple factors play in India's expertise in chemical engineering, whether it is chemicals or pharmaceuticals, high quality of production, as well as some amount of China plus one shift, which is happening across sectors, will continue to benefit us. CDMO and those businesses, by definition, will remain slightly more bulky and chunky, and hence one might see some volatility up and down going forward as well, like we have seen in the past. But structurally in an uptrend for sure. And same with hospitals and healthcare. The incidence of Indians reaching the bucket where they can afford a better quality healthcare is rising. The penetration of health insurance is rising. India is sort of a health tourism destination is also improving. So that business also seems to be in a structural trend. So the entire sector, I think, should do well over the next 5-7 years.
Okay. Could we extend that argument to two other large sectors, which is BFSI and IT? Let's start off with BFSI. Almost everybody on the street, I don't think there is an exception to this rule, is constructive on banks. One doesn't know when would that uptick come, but for now, save for select private banks, the larger ones have been sulking. Yeah. When can we make this case that bhai ab ho jayega? Now we will see them move. I mean, how do you make that case?
So two things in terms of banks. So the larger ones have been sulking not because the larger ones have been doing badly, but simply the rest of the sector started doing so well, right? So what we have seen in the last 3 years in banking is a mirror image of what happened between 2015 to 20. So in fact, in one of the recent newsletters that I wrote, I actually published a very interesting chart where I showed that if you look at the Bank Nifty constituent performances for between 2015 to 19 and 2021 to current, it's exactly a mirror image of each other. So 15 to 19, Kotak and HDFC were up between 150 to 175%. And amongst the large banks, SBI, Bob were right at the bottom with -10, -5, +5, etc. 2021 to now, BOB is up right at the top at 177, SBI is about 150, and HDFC and Kotak are right at the bottom with just 5-10% performance. And the reason for that is the other banks which are not doing well in 15 to 19 started doing well in this horizon. So if you look at FY24 numbers, it'll be very difficult to distinguish between the top 5 large cap banks, whether it's ROE, growth, NPL ratios, etc. All the metrics look very, very similar. So there has been a valuation convergence in the banking system. So the bigger guys' valuations have come down by the stocks not doing much and the earnings rising. And the names which struggled between 15 to 19, the valuations have caught up by stocks performing. So at some point of time, the whole convergence process gets over. Sector is doing well. I don't see a big issue in the sector. The growth is intact. There are no big challenges on the credit risk, at least for the next few years on the horizon. So no reason why the sector as a whole can't start delivering good performance going forward.
Mm-hmm. Okay, so Okay, that's on banks and some insights there too. The other one is information technology. Now, whether the rate cuts or the rate cut chatter improves sentiment and valuation multiples argument is one thing, but until recently, none of the companies are talking about demand turning at the corner at all. No visibility there. Would this be therefore, would this be too early for somebody to look at IT, never mind the fact that they are high quality companies?
I think IT might struggle a little bit this year
Okay.
in terms of growth pickup. So, US is as we all know, US is a hardcore capitalist country. And sometimes I feel a little strangely hardcore capitalist country because once I say it, you'll be able to see that in perspective. That US companies start dialing down on expenditure, even if there is a fear of a slowdown coming in at some point of time down the line. They don't really wait for a slowdown to come in before they start cutting expenditure. And that's what has been happening in the US right now. Every single economist is calling for a growth slowdown. At some point of time, it hasn't happened yet. Few even calling for a mild recession. Again, no signs of that yet. But those calls by the macroeconomists is enough for the companies to say, hey, let's just postpone our spending for some more time. There's no hurry. And they just do it time and again. And hence, till such time that whole cloud on whether US economy slows down or not goes away, whether it actually slows down or not is immaterial. I don't really think US companies will bump up their budgets in a big hurry. And hence, IT will continue to do their middling sort of a performance. But if the markets were expecting or hoping for a big bump up in spending budgets by the American companies and hence a big pickup in growth this year from IT sector, it might be a cause for a disappointment.
Fantastic insights. Dhiraj, lovely talking to you today. Thank you so much for taking the time out and being with us, and see you in the studios sometimes.
Thank you. Would love to drop in.
Great. Thank you. And viewers, with that, it's a wrap on this edition of Talking Point. Thanks so much for tuning in.